All right. So the last panel that we had started to touch on the concept of credit, borrowing and lending in the Bitcoin ecosystem. This next panel is featuring Trey Sellers of Unchained and Matt Dines of Build Asset Management. And we have two special guests here who are Unchained customers. We have Kelly Lannan and Bryan Gibson, and we're here to talk about Bitcoin balance sheets and borrowing and lending. So take it away, guys.
Thanks, Dave. We good on the mic? Can you all hear me? Good. All right, well, thank you for having me. As Dave mentioned, I'm Trey Sellers. I am in enterprise sales at Unchained. And for those of you who don't know what Unchained does, we provide Bitcoin financial services. We help people acquire and hold Bitcoin, secure it in the best possible way. And then we layer on some financial services beyond that. So we have Bitcoin IRA, and we also have Bitcoin-backed loans. And so that's going to be a topic of conversation here as part of this panel. Before we get started, quick introductions. Kelly, you want to kick us off?
Yeah, hi everybody. My name's Kelly Lannan. I am a real estate developer and builder based out of Phoenix, Arizona. I'm also part of the Bitcoin community. I write a little blog called Bitcoin Urbanism, which is kind of the intersection of real estate and Bitcoin.
Right.
Yeah, my name is Bryan Gibson. I ran a union painting company out of just outside of Chicago for about 15 years. And the way I got into Bitcoin was it's a very competitive, low margin business. And I was always hearing that you got to grow or die, grow or die, grow or die. And so we had to keep on taking on more and more risk every year, higher payrolls, just to make the same amount of money. And that's when I started looking into why that is. And I realized that it's basically you're trying to outrun the money printer. You're constantly trying, like if you grow at 5% and inflation rate is 10%, you're getting poorer. So yeah, that's basically how I found Bitcoin, which gets you out of that system.
Great. I'm Matt Dines. We met earlier today, but right now I'm going to talk about on this panel with these guys our partnership that we've launched with Unchained specifically to provide dollar capital into these entrepreneurs.
Yeah, thank you for that. So you both hold Bitcoin on your balance sheet, both as a person, right, and as an individual, and in your businesses. What's the benefit that you get from holding Bitcoin on your balance sheet as a business? Why do you do that?
So for me in our business and development, it's a very time-intensive operation. So in our circumstance, we're vertically integrated. So we do everything from property acquisition to the entitlement to the actual construction, and then through to the disposition and the sale. So as time has passed, it's a family business, so since the last 35 years, it takes longer and longer to go from step A to step Z. So in our business, there's no cash flow during that process. So if we're looking at a situation like the last 10 years where the money printer is literally just going burn nonstop, we have an issue where our costs are going up while we have no cash flow. So for me, it is essentially parking funds in something that is protecting me from that from the inflation over that time. So if we are trying to run a business and we're not getting paid till the very end, where you're just literally getting poorer the whole time, you have to be able to defend yourself. So for our circumstances, we found that holding Bitcoin, especially over a 6 to 8 year time period where we're trying to build buildings or create value, that is the way to do so.
And I hold Bitcoin basically because it's the least risky asset that I've found. It's the one that is not going to change on you. With stocks, you don't know how many they're going to print and dilute you. With real estate, you don't know how many they're going to build. If you invest in a Subway franchise, they could put a Jersey Mike's right across the street. You don't know that. Just Bitcoin is just the one thing that is not going to change. Michael Saylor talks about building your economy on Bitcoin is like building on granite. It doesn't move. Whereas, building your economy on fiat, it's like building on sand. It's constantly moving, and Bitcoin is solid, and you can count on it. It's a hard asset.
Yeah, so you're holding some portion of your balance sheet in Bitcoin, but probably not 100%, right? How do you think about the allocation of Bitcoin as a certain percentage of that balance sheet versus some other assets that you might have?
Well, so for being a developer, you're basically land heavy. You own a lot of land, or you're in the process of building something, so you are putting a lot of capital out there that is not yet essentially usable. So for us, for me, it's as much as you can possibly afford, essentially, because I'm not getting paid till the end, so I have to be able to protect myself until that time. Now, that doesn't always go the way you want, just because real estate is real estate, but at the same time, it's a value judgment in saying that if I know what my expenses are going to be, if I make X dollars from the last job and I know my expenses are Y dollars into the future, what's my margin that I'm comfortable saying, okay, well, if I put half of it in Bitcoin to save until the next time I get paid, then that's what I do. If it's 25%, it's 25%. So it's basically looking at your future cash flows and trying to figure out, can I afford, to save this much, or do I need to have essentially a margin of safety for unexpected expenses, or just to pay rent, essentially. So.
Yeah, and Bryan, you said you view Bitcoin as like the safest asset that you could be owning. Mm-hmm. Do you view it differently than Kelly, or how do you approach it?
Yeah, I mean, I pretty much over the years divested from everything besides Bitcoin. I mean, I obviously hold some cash for day-to-day expenses, but I try to hold as much as I possibly can in Bitcoin.
Very good, cool. So having this asset on your balance sheet, along with other assets that you might be able to leverage, you can actually borrow against that. Is that right? How do you think about that process? What considerations are come to mind when you're thinking through when you're borrowing, how much you're borrowing, and just what does that look like from your perspective?
So for us, a lot of times, if you're in the business and you don't have, let's say that you own a piece of property that is not leveraged or doesn't have a construction loan or any of these other things, that provides you a route towards some liquidity. But in a lot of times with land, if it's not an income producing loan, where the land is the collateral, you have a much more difficult time getting funds. So on the flip side, if you're not holding land as a savings vehicle necessarily, and you're holding Bitcoin instead, your time to liquidity is 48 hours. If you're, if you get all your docs done, you can transfer the Bitcoin to the wallet quickly enough. Otherwise, if you have, let's say you own one of our projects we decided to own, right? Multifamily real estate. We'd have to go through the underwriting process with the bank to get a HELOC or a loan, and not necessarily HELOC, but you would still have to take 30 to 45 days to go through all of the steps and processes, the appraisals and all that, just to be able to be provided liquidity. So in the land business, cash is king, and if you are able to access cash more quickly, you are able to strike at opportunities faster than anybody else could. So it provides a route that you can save, and if you need to access cash, you can do it literally within 48 hours. And I couldn't even dream about getting a phone call back from a banker in 48 hours. So no offense to the bankers, it's just part of the process.
Yeah, Bryan, how do you think about this? What do you see from your perspective? How are you using the funds that you're receiving from this?
Basically the reason why I get loans against Bitcoin is I think it's the best way to realize gains in Bitcoin. If you when you sell Bitcoin, then first of all you get hit with a big tax bill, and then your asset's gone, and you can't use it again. If you keep, when you get loans against it, you can retain possession of the asset, and you can keep on using it over and over again. You can refinance it as the money printer keeps on inflating assets. You can refinance and you can use it again and again and again. Again, Michael Saylor talks about like wealthy families that own buildings in New York. They don't sell those buildings to realize profits. They loan against them, which also, when you take out a loan against your Bitcoin, that's tax-free, and that's huge. And then you can do that again and again and again.
Yeah, interesting. So, when it comes to, using an asset like Bitcoin to get credit to expand your business and that kind of stuff, you kind of hit on this a little bit, but it's quick, it's easy. Can you elaborate a little bit more on the problems with going the traditional route and why you either can't or don't, take credit to expand your business from banks or other financial institutions?
Yeah, it kind of comes down to that the paradigm is now different. So if we were a typical land business where we didn't have any Bitcoin, we would have additional land essentially on our balance sheet that may be developable in the future or that we would develop. So it would start to look like, okay, well, if this is not in, I guess, the next 10-year scope for us to develop, can we, get a loan against this? And then do we have expectations for these projects to do well enough to pay these loans off? You're kind of playing musical chairs with what am I going to do business on and what do I need to borrow against for some immediate purpose. That math all changes because you just don't have to do that anymore. Sorry, I lost my train of thought. You don't have to go through the process in order to do that. So if I wanted to get a loan against land, like I had mentioned, you go to a bank, you have to go through a process, a credit check process, underwriting, appraisals, all of these other things, and that just takes time. So unless you know that this emergency expense is going to happen 45 to 60 days in the future, that's great. You can start the process now. But if not, it's much easier to gain access of liquidity through Bitcoin than it is a traditional asset like real estate. So to me, it's why necessarily deal with that, especially when there's weed notices for lots and all the other expenses and stuff that you incur just by owning it versus having my Bitcoin, safe and secure in a multi-sig wallet. So,
Bryan?
The Bitcoin loan process is just so much better than getting a loan against real estate. It just takes a lot longer for the traditional, real estate loan. And then Bitcoin also is pristine collateral. Like when they come out and they appraise your house, they never appraise it again. And your house a lot of stuff can happen to your house. But with Bitcoin, when they're holding that as collateral, it's pristine. Bitcoin can be in an address for 100 years and it'll still be one Bitcoin. It doesn't degrade like real estate. So that's why I think the process is just so easy. I was taking out a traditional loan against my house, and then I had a loan with Unchained at the same time. And the one took 3 months, and Unchained took 3 days, and I had the money. And that's very beneficial for many different reasons.
Yeah, time is money, right?
Yeah, exactly.
I think you're hitting on a really important point around Bitcoin as an asset and its use as collateral and the advantages that it has over other traditional collateral assets, even U.S. Treasuries, gold, real estate. There are many other assets that are used as collateral. Do you mind digging into that a little bit further? Like, what do you see in the kind of macro landscape here around Bitcoin as a collateral asset?
Frankly, I think the moon is the limit. There's a popular saying in Bitcoin that the price is going to go to the moon, and that it's also Bitcoin's usability as collateral. When we're talking about like land as underwriting or these other processes that have to happen in order to realize some sort of borrowing, right? It could be against anything. It would be against your car. That there's such a huge process involved in underwriting, and can this person pay? And if, to use the car, they get a car loan and they stop paying, well, how are you going to find that Corvette? You know, unless you've got something attached to it that you know where it's at all times, it could just walk off. With Bitcoin, it's very different. Okay, you send Bitcoin to an address, and especially with Unchained, it stays there. Okay, so I've kind of said this a couple times in trying to explain it. Bitcoin is the collateral at the same time that it is the underwriting. Okay, because the underwriting is, does it show up to the deposit address when it's supposed to? And is it there? I can verify it's there. Every Bitcoin miner or node operator on the planet can verify that it's there. So you've now changed the game to where the asset that you want to borrow against or lend against is not going anywhere. You can verify that it's there all the time. It doesn't degrade. It doesn't have prior claims to it. It's just there in the form of Unchained. A group of people have to agree that essentially the loan's been satisfied or that it can be moved. So it's kind of like a loan where it's a Mexican standoff. Everybody has something in the game, but at the same time, nobody can do anything unless there's a majority that agrees. So it doesn't go into a black box. You're not worried about, as a borrower, your Bitcoin disappearing into BlockFi or FTX or any of these other places that have shown you exactly what they were willing to do with your Bitcoin. So I really think that this brings the idea of a trustless network to a trustless business sense, where I don't necessarily need to trust my counterparty in order to get a loan or how to treat the collateral.
So we'll talk about that a little bit. So Kelly and Bryan have mentioned, like, you're lending in to the entrepreneur here. They're delivering a good and service into the real economy. Kelly's building houses. Bryan's a professional painter. So you have that element of how you would typically lend against a borrower. The collateral on the back end of that, the Bitcoin behind the loan, well, why is that special? You know, there's a lot of credit out there. Parker mentioned earlier today, the Fed presents a metric where they count up all the debt in the system. It's $97 trillion now. There's a lot of IOUs out there, and a lot of the time it's just another IOU that's presented as collateral behind, you know, a loan. The entire financial markets are built upon essentially like leveraged borrowing of the treasuries, and the treasury bills are themselves just kind of bootstrapped up by thin air.
It's turtles all the way down, right?
On government borrowing, and we learned with the debt ceiling this June, if they didn't just keep increasing that ceiling and bringing more treasuries to market, they wouldn't be able to cover their interest payments. They wouldn't be able to service their debt, and this thing would just gradually then suddenly like just collapse upon itself. So like the gold standard, I would say, for collateral instrument in the financial system, it is that T-bill. Why is that? Well, we're all kind of coming to the cognizance of the fact that exactly that scenario is what's playing out now as we've pushed the debt saturation in the economy to I don't know, well past the breaking point, if you will. The sponge is full of water, but the best assets where most of the borrowing stands for your money market funds. On the back end, it's repo markets and T-bill lending. Why? Because that's the most liquid market out there. So you have 5 T-bills issued every week. Like, they're getting to be massive issuances, like $75 billion, $90 billion each one. We create one of those every day almost, like a new 1 month, 2 month, 3 month, 6 month, and 12-month bill. And they're adding new ones in just to be able to keep running this level of deficit that the economy needs to keep this system going. Where I'm going with that, those T-bills are the choice of the financial system because of the liquidity, because there's always a bid-ask for those instruments. Now, Bitcoin is the challenger here, and just by itself, the Bitcoin to dollar, just daily tradable market, is now to a point where it's on par with the depth of liquidity as like one of those on-the-run T-bill issues. So like, let's say your best T-bill would be like a 4-week treasury bill coming in to mature, and that's what the big money center banks in New York and London and Singapore and Tokyo will use to basically keep this system liquefied and running every day. But what these guys are doing is challenging from below, and they're the ones out there actually delivering the real goods and services into the economy. So when you're investing into credit, and this is where most of our savings are, and we're looking at a problem now as this system is breaking down. I was talking to a lot of my family who is 70 to 80 years old this week. They say their bond portfolio is now down 25% since 2020. On top of that, you've taken 20 points of inflation. So you've lost 45% of your purchasing power. And you've got to figure this out and stay ahead of the game. And that's where I think this whole kind of beautiful flywheel comes in on what is emerging here in this space. So if you're a senior, you're on a retirement income, you've got your life savings kind of squirreled away in a nest egg. That's supposed to get you through, like, from now until the rest of your life. If you just take a minus 40%, you're in a real big pickle. That was not supposed to happen. So the answer the question that we came with, and what I was trying to find was, how do we help these people? Because that's just an unacceptable problem to put people through. And now if you start connecting the dots here, how Unchained is servicing the loans, the multi-sig vaults, the over-collateralization, minimizing duration, and then also this is a key topic here. They are charging high interest rates for these loans. That is just where this market is at because of the emergence. There is not that much dollar capital in this space. That's why we have to use it wisely, both in what we're doing as borrowers and delivering goods and services into the economy, but also using that dollar capital we have in a very risk-managed way. So here's the last thing I'll say about this. For a senior citizen, even to keep your nest egg at break even, the highest this latest inflationary impulse got was June of 2022. We got up to 9% annual inflation. Now, let's say your nest egg, which is going to skew towards bonds, as the financial kind of industry standard wants to do in this era. That's technically best practice. That's what everybody in the advisory business does, institutional asset management. They're telling us this is the best practice, although you just lost these seniors 40% of their purchasing power in 3 years. So obviously broken there. But just to keep that person's nest egg above water, if they're going to continue doing that and maintain its purchasing power through time, you've got to beat that 9% hurdle on that CPI impulse, the top of the mountain. But you've also got to beat taxes. So most of the savings here, if they're not in a tax sheltered account, you're going to have to add another 20, 30%, whatever your marginal rate is. And it begins to look like just to stay above water, you need to be delivering an 11, 12, 13% yield. Now, if you are locking in for a longer term duration, you're going to be in that situation where if everybody's following the news, the financial headlines, you're seeing a massive sell-off in the treasury curve as markets are coming to the understanding of the reality of this debt situation we're in. So you marry these things all up, you provide capital into the businesses who are, I would say, challenged. Like, traditional sources of capital don't want to lend into the small business, the entrepreneur. It's actually hard to do now, especially hard to do, but it's been a problem since 2008. And if we utilize all these pieces together, we're bootstrapping a system that works for all participants involved.
Yeah, you're hitting on liquidity there, which is so important for any kind of collateral asset. And we typically think about that as, how can I get out of this thing? Is there going to be a buyer, a ready buyer there? And we're not going to move the market too quickly. But another key point here is, can you do that when you need to do it? And Bitcoin trades, 24/7, 365, all around the world. And so, if you are collateralizing a loan with real estate, that real estate is fairly illiquid, right? It's got bespoke characteristics based on its location, based off of the form that it's in, and all of that. It's probably going to take 30 days to close on that. So from a lender's perspective,
Yeah, if you're lucky.
if you're lucky, right? Yeah. And so from a lender's perspective, makes all the sense in the world to accept collateral that can be liquidated pretty much instantly. right? And on a Saturday evening at 9 p.m., right? So, good. Bryan, we've talked a lot about Bitcoin-backed loans generally and why you use them. Why did you choose Unchained, not only for the loans, but also for the security of your Bitcoin?
Yeah.
What are the advantages that you see there?
Well, so actually, when I was first taking out loans, it was kind of a brand new field, and so I kind of diversified my risk. I actually took out one loan with Unchained, and I took out a loan with BlockFi, and they were just two totally different experiences. With Unchained, you send the Bitcoin to an address, and it sits there as collateral, and you can see it. And I think my first loan was years ago now, and you can still see it to this day in that address, which is pretty comforting. With BlockFi, I sent them the collateral, and within 5 minutes, you could see it on the blockchain. It's moving. It's gone. They got right into it, and so the more I started to learn, they started working, yeah. And the more I started to learn and the more I used to see the way they were doing things, I ended up just closing out that loan. I had that loan open for maybe 2 or 3 months, closed it out, and didn't lose anything. And Unchained, stuck with them, and when everything we went through with all the bankruptcies and everything, I could always look at that address and see that my Bitcoin was safe. That was pretty, and I think that's eventually now, that's kind of worked its way out of the system. I think that's what everybody will probably do moving forward. It's a really bad idea to rehypothecate Bitcoin, and I think people are finding that out very quickly. And so I think that
Let's cover that word, because that's a complex topic. It gets into the machinery. It's like opening up the hood of the financial system and how this thing works. And we've all bought into this system, like the primary savings vehicles or stocks and bonds. But this word rehypothecation, what does it mean? You think about your stockbroker or whatever when you log in to your E-Trade or wherever you have an account. Most everybody probably has one. It says on there you own one Apple share or one Amazon. What is that actually? You don't actually own the share. It's a claim on a share that's managed in a centralized database with the DTCC. In the olden days, your grandfather or his before that, you might have gone to your safe in your house and had a stock certificate of Disney or Union Pacific Railroad. That was the real thing. It was a bearer asset. And there was no rehypothecation of your stock share. And what we mean by that rehypothecation is it's lent out by your broker-dealer for their own profit or benefit. And so what's happened as we've put up all these layers between us as the ending or the final beneficial owners of these assets versus where the actual asset is now, we just hold the credit claim on those. They're going out and lending those into a market, and this is how the financial industry makes their money. Your one Apple share, you think it's there, but odds are it's already been loaned out to someone else who wants to short it, for example. So there's always going to be more shares actually outstanding on the front end of users who think they own a stock than there are on the DTCC. So it's essentially been fractional reserved. And so how does that get into problems? Well, on the other side of it, you've got borrowers who want to borrow those shares. And so they want to short a stock into the market. And you see these dynamics where when push comes to shove, eventually you get into these situations where there's actually more shares that people think they own than there are on the back end. So that's what we mean by rehypothecation. It's the use of the asset for your third party's beneficial interest. How does that get you in trouble when you're taking a loan? Well, if you can't show that the collateral hasn't moved, you technically don't have an asset anymore. If you've pledged your asset and someone takes it behind the door and does something else with it for their own profit. Bryan hinted at this. There was example in this industry and example after example who would take the Bitcoin, move it to a third party, engage in a daisy chain, sometimes 7 steps down. And if you go to the bottom of the well and where this ended up, it was in some crazy hedge fund in Singapore making really speculative leverage bets. Well, guess what happens when the market tightens up? that hedge fund ends up not being able to make good on its own debt. Someone owns the Bitcoin somewhere, but it can't make its way back to Bryan as the end borrower, and he's out of Bitcoin, right? So he just lost because of the risk that his counterparty was taking. So from that aspect, it's actually, if like the reality of this is, if you are enticed with a lower rate, but you don't protect yourself, or your lender can't prove to you, or as the borrower, that they're not going out and making engaging in economic transactions for their benefit but not your own, that's when you actually, are not actually borrowing at a 5% yield. You're borrowing at a minus 100 because it ends in disaster. So that's where what Unchained is built, and the way they've operated here has actually built out a resilient lending model that actually works in the best interest over the long term for the business owner like Bryan and Kelly. And it lets them keep coming back, not just day to day with their business, with their projects, but it's actually like cycle through cycle. Because if you take a minus 100, guess what? Your business is over. Like, you can't re-bootstrap yourself back up after, Kelly's business, I know, is multi-generational. So that aspect of doing this the right way is mission critical to achieving these successful outcomes.
Yeah, I've used that same example to prospective clients who are asking, what's the difference between an Unchained loan versus BlockFi? It's like, yes, you're going to pay 6% on your BlockFi loan, but actually the risk-adjusted rate is 106% because that went to zero. You lost all of that, right? And so you have to take that into account. That's where that rehypothecation comes into play. And that's really the same dynamic at play that what Parker was talking about earlier today, where you have all of this leverage built into the system and only so many dollars at the bottom of that, but all of these claims to those dollars. And it's a game of musical chairs in the end of the day.
And this is like, or why wouldn't you just have a lender of last resort to kick in to keep the game going? And then we're back to square one where we were at this morning, and you have just this continuous debasement of the currency, the loss of purchasing power. So the only real way, like, you're still painted yourself into a corner. The answer is you need a sound money. You need a ledger money that can credibly enforce its supply cap to gain the economic trust between partners engaging in transaction. So at the end of the day, there's really no way out of this. It sounds complicated, it sounds complex. Why are you doing this? Lending into Bitcoin, lending into the entrepreneurs. But over the long term, I think there's no other resilient approach.
Yeah. We have, I think, 1 or 2 minutes left. We've talked a lot about the reasons why you would want to borrow as a borrower, and how you're using those funds and that kind of thing. What can go wrong, and how can you plan for that and react to that situation?
Well, China can ban Bitcoin mining again, or FTX could sell all of their customers Bitcoin again. So there's things that you have to take into consideration that are out of your control and that are going to hit the price. So you calculate that into your risk tolerance. So Unchained loans at 40% loan to value, if I'm not mistaken.
Yep, that's right.
So if you need cash quickly, but you don't need 40%, but you want to protect against something happening in the middle of the night, you can lower your collateralization ratios. So you can have protection from huge price swings while you're sleeping, and then you just have to plan it if whatever you need the cash for doesn't pay off right away, right, or pay off as you plan. You just have to know that your cash flows have to be able to cover your interest expenses, like on for however long you think it's going to take. So I mean, from the borrower's perspective, there's a limited number of scenarios for the Bitcoin where you can model it out in your Excel spreadsheet or at your kitchen table in your head, where you can say, okay, this could go wrong, that could go wrong. CZ with Binance could be selling all of their customers Bitcoin as we sit in this conference. And then what would that do for my loan? So you can kind of think about those things and adjust your expectations or your requirements to protect yourself. So
those type of calculations are exactly what the entrepreneur is supposed to do. That's that's the deal that they make with society. They take the risk. They make these calculations at their kitchen table. The risk shouldn't be with the 70 to 80-year-old retirement beneficiary who has to take a 40% loss in purchasing power, and now the remaining 15, 20 years in their life, they have to question, is this going to work for me? So that's the way I approach this, and this is the right way, as opposed to an alternative path that treats our seniors that way. So I'd say that's my final thought. I think this is it's a much better way to balance the risks in your society versus those who can tolerate it, those who are out there doing the work, versus those who have saved their entire lives and put their trust in this system, and it's not there to deliver for them when you need it most.
Very good. Bryan, 30 seconds, final thought.
Yeah, there are some things that can go wrong. I probably took on a little bit too much leverage on my loan at first because when you really understand Bitcoin and you understand that it's unconfiscatable and undebasable, and you start to get maybe a little bit too bullish sometimes. That's a very common thing. And I took out a loan. It was maybe a little bit of a stretch. Everyone in the industry thought Bitcoin was going to 100K, and I thought for sure. I thought I was kind of conservative, and so I thought, you know what, I'll take a loan based on that, and then when we get close to 100K, I'll refinance, and then I'll pull out some collateral, lower my risk. And then about 4 days after I took out the loan, the market topped. So I had to, over the course of the next year, I had to always kind of constantly reassess my risk and sell off some collateral and manage the loan until it got down to a safe area. But I think what I learned from that is you have to leverage the right amount. Always be ready for an 80% drawdown at any time in the cycle, and you'll probably be fine. I think Bitcoin's drawdowns were 90% was the first one, then it was 85, then it was 82, I think the last one was 77. I don't think it'll ever go down 80% again, but I will be ready at any time, I can tell you that. So that's important to stay in a strong position and not get ahead of yourself, basically.
All right. I think we're out of time. Thank you so much, guys.